All right, good afternoon, everyone. I can see people joining in very fast. Welcome to the webinar, guys. Very good afternoon. Okay, we are going to get started in the next minute or so while we are waiting for more folks to log on. Let's get to know more about each other. Drop your business name and what you do in the chat box so that we interact more efficiently. I would love to see who all are there with us on the webinar today. Hey, I'm sharing my screen meanwhile. Let me know if you guys can see the presentation up right there. Okay. Okay, I could see the chat is disabled. Let me check. All right, it should be running, but if not, maybe we can use the Q&A box as well. Could be the server issue. All right, let's start it. Very good afternoon, one and all. We are starting with our webinar today. Again, welcome to today's webinar, Meet the Beast with Adam B. Struck from Struck Capital, presented by Early Growth. My name is Khushbu, and I'm Event Marketing Manager with Early Growth, and I'll be your host for today. Just a few housekeeping notes for you all. This webinar will last approximately 60 minutes, including the time for Q&A at the end. You can place your questions in Q&A panel at any time. This webinar will be recorded and sent to all registrants within 48 hours of this presentation. You can also find this recording and all of our previous webinars recording on our YouTube channel. This link to the YouTube channel will be sent to you in our registration and the recording email. Something about Early Growth. Before we get started, let me tell you more about us. At Early Growth, we have got the entire finance stack covered. What that means for you is really two things. First, you have got a strategic partner in your growing business. Our CFOs, with their years of experience and dozens of startups under their belts, help you see what's coming good or bad and take advantage of it. From strategic decisions to fundraising, they have seen it all before. Second, our CFOs and senior accountants and tax advisors take care of all of the blocking and tackling related to the day-to-day, month-to-month, and year-to-year of your finances so that you can focus on your business. Both Early Growth and our CFOs have been around the block a few times. We have helped and served over 5,000 clients coast to coast and around the world, approximately 40 countries. As always, our CFOs have helped our clients raise billions of dollars, and we would love to help you and serve you as well. What we believe in delivering peace of mind by providing you all one-on-one solutions for all of your needs, requirements, including CFO services, HR, accounting, taxes, and insurances. We'd like to protect your profitability by giving you a sole point of contact to answer all kinds of questions and strategic dashboards to help you understand your business and company better. We want to be your partner in growth to help your business grow by working in the backend so that you can focus on the growth side of your business. So we have a promo running. You probably have started planning your 2022 taxes already. If you want to get a provider in place before the end of the year so that you can do an effective tax planning before the year ends, we have a promo running for you that now. You can get $500 off on your 2022 tax preparation. Just to kick off, I want to do a quick poll questions to see who's there in the room. This poll will start in next 10 seconds, and it will be up and running at the end of the webinar, so you can fill it at any time based on your requirements and your necessities. It should be, yeah, it should be there on your screens now. Awesome. So your team is very critical to your success, we know, and that's true whether you're running a, you're building a startup or you're putting together a great webinar. We have got a number of great partners in the startup community, but for today's event, we have the best of the best. Early Growth has always been focused on the team, the community, and we know that together we go further. To bring you today's webinar, we have a trained startup trained. And to tell you more about our partners, we have our moderator, Greg Manley, with us. He's working as a senior manager of business development at Early Growth for over 4.5 years. Prior to joining Early Growth, Greg was working as director of sales, accounts, and marketing at Saturnus Design LLC for a year, where he had actively sold enterprise and AM law 100 to 200 accounts and identified new sales opportunities as well. He has also worked as enterprise account executive as Dato for approximately 2 years, as well as starting his sales career in San Jose Sharks, joining the club in 2013, and helped with the team's professional evolution, including launching their minor league brand, the San Jose Barracuda. I hope I'm pronouncing it right, back in 2015. Craig enjoys traveling and shark diving. That's very interesting. He's an avid sports fan and a film buff. Before we proceed, just a reminder that you have any questions for our VC, please put them in the Q&A panel, not in the chat, if it's running. So now here's to introduce our partners and to take over, Greg Manley.
Awesome, thank you so much. Let's see if I, cool. So again, thank you for everybody for joining here. I'm happy to introduce you to our partners this way. So first off, would like to introduce the team from PacWest Bank or Pacific Western Bank. I don't know, Peter, Brady, which one you want to jump off?
Pacific Western or PWB works great. Thanks, Greg, and thanks for having us on. So I head up our startup services team, which focuses on pre-Series A companies. So the idea for us is to provide early stage banking products to companies as they move through the funding round, from incorporation through seed up to Series A, when we can work with them on venture debt and those types of things. So the idea for us is to start early to try to help companies with the banking needs that they have, as well as kind of the community and fundraising needs that they have as well.
Perfect. And on the law side, we have O'Melveny. I had really tough time always pronouncing the firm name, and I'm always sorry. So, but yeah, if you want to give a brief background on what you guys work on and who in sort of the areas in the startup community that you work with, happy to go through.
Sure. Thanks, Greg. And my name is Hale Boggs. It's O'Melveny. And as Greg mentioned, we are a law firm originally founded here in Los Angeles, where I am and where Adam is, but really international in scope these days. We have a large office in Menlo Park, which is where our emerging companies VC practice is sort of based, but we do that work for emerging companies kind of across the spectrum from, as Pete said, sort of pre-seed all the way to exit. And as a larger firm, we're able to kind of help our clients, really across the spectrum of their needs as they grow. We have teams in addition to Silicon Valley, San Francisco, LA, New York, and then we have several international offices where we're actually doing a good bit of emerging company work as well, including work out of Israel and London. Would love to have an opportunity to meet with or chat with any of you guys about your legal needs as you grow your companies.
Thank you so much, Al. I really appreciate it. And then last, but certainly definitely not least, Insperity. So Chuck, you want to kind of run through, how you guys can, be of a value.
Yeah, absolutely. Thanks, Greg. So Insperity, we are an HR company. We're headquartered in Kingwood, Texas, but we have 90 offices throughout the country. I personally sit in our Providence, Rhode Island office. And what we do is we work with our small to mid-size clients on all things people related. We believe that your employees, your people should be your best and most valued asset. So what we do is the full employee life cycle, things from payroll, benefits, compliance. We're there to take over the don't necessarily want to but have to pieces of the business that will allow you to continue to focus on what it is you love doing and why you got into business for yourself in the first place, knowing that everything you're doing as an employer of record is fully compliant. Ultimately, it's can we help you run better, grow faster, and make more money?
Awesome. Thank you so much. And then let's see. Gitri, I don't know if you want to flip to the next slide here.
Here you go.
Awesome. Thank you so much. So in the last introduction, of course, definitely doesn't need too much of one, but is today's VC. So Adam B. Struck. So Adam is the founder and managing partner at Struck Capital. He's been doing it since 2015. He has also founded Struck Crypto and Struck Studio. And before Struck Capital, he was a co-founder of Long Island Brand Beverages, a CPG company acquired by Cullen Investments and taken public on the NASDAQ. So long history back there. And then earlier in his career, Adam was an M&A PE attorney at Kirkland and Ellis, one of the largest firms in the world. He was also recognized for his work by Forbes 30 under 30 list for venture capital. So congratulations there. Adam graduated from Northwestern University Kellogg School of Management and Georgetown Law before going into law himself, and then originally hails from the beautiful country of South Africa. So Adam, welcome to the webinar.
Thanks, Greg. Happy to be here.
So I know I was able to kind of just sort of go through a little bit of your background on a profile side, but I think the best way for us to kick this off is telling us about your path and what got you into venture capital, especially after that long history of business in the past.
Yeah, I decided to go to Georgetown Law. It was right around the 08 crisis, and I kind of just felt that if I got sort of law degree, it would put me in a place where I could theoretically be, a stronger entrepreneur or a stronger businessman. And I then really sort of got pulled in by Kirkland and Ellis, which was a really incredible firm to be at. But I kind of then realized really quickly when evaluating sort of people that had been at Kirkland for 10 or 13 years and were gunning for non-share partner that, sitting in a room billing 3,000 hours a year was just not necessarily the highest and best use of my skill set. So I really decided to place a bet on myself and left, after having a really strong first year. And then my brother and I were, essentially started Long Island Brand Beverages, scaled that to over $40 million in top line in under a 5-year period, and then had an exit. So I was sort of sitting there and saying, wow, I've got, these operational expertise, legal expertise. What's sort of the best way to sort of move forward in my career? And I kind of realized that, as a venture capitalist, you're investing capital, into portfolio companies, but you're also sort of playing the role of, coach, mentor, even therapist for founders. And I just naturally had a robust network of people in VC, various founders. So then I said, maybe this is something that I would like to do. So then I started putting sort of special purpose vehicles together, because it's very hard to get somebody to invest in a fund on a fully discretionary basis when you don't have a track record. So it was much easier for me to sort of, flex my ability to get into, sort of deals where it was very difficult to get on the cap table and have people essentially invest in the company. And then, I could sort of leverage my skill set as a strong salesman and really sort of sell the business. So I definitely had a lot of beginner's luck because I was able to meet Bastian Lehman from Postmates when he graduated from the Angel Pad Accelerator. He pitched me on what he called the industry agnostic operating system for the gig economy. I was able to basically put an SPV together, put $450,000 into the Series A with Postmates. So that was my second deal ever. So very good outcome there. And then, yeah, basically had to really grind, did around 18 SPVs, and then finally got to a point that I could raise my first fund, which was a $32 million fund for Struck Capital, which was a 2017 vintage. So yeah, it was a confluence of quite a few events. There's been a number of sort of lawyers that have been very successful in VC. Chris Sacca, in my opinion, is sort of the gold standard there. He actually went to Georgetown Law as well. So had some, sort of had individuals prior to me that sort of paved the way. And then I just really sort of, put in a lot of effort, had some luck, and it was a good outcome.
Awesome. No, that's quite the adventure to get to where you are today. So, even though I hope the audience has done, the research on the fund, and I was hoping you could give us an overview of sort of your investment thesis and fund formation. Just quickly before you do that, just want to let anybody know that the chat is disabled at the moment. So feel free to answer, putting comments or questions into the Q&A box, and I'm happy to, keep an eye on that for the future as well. So please, jump on that. It looks like it's now working to everybody. Cool, chat's working now. Do you need me to repeat that question, Adam? I'm sorry.
So basically, just sort of Struck generally.
Overview of your investment thesis. Yeah, sort of, the fund formation, kind of, what's sort of the backbone to what Struck Capital is.
Yeah, for sure. So we really want to be seen sort of as early stage specialists. The thesis of Struck Capital is basically to just back, incredible, ideally technical founders in sort of that first round of institutional financing. We want to come in, we want to write a term sheet, take a board seat, price the round, and then we really want to live and die sort of by our platform. So we've infused a lot of core technology innovation into our firm and fund to be able to add value to our portfolio companies at scale. We fundamentally believe whether it's horizontal, vertical, SaaS, fintech, martech, Web 2 or Web 3, there's just a lot of pattern recognition as it relates to getting from 0 to 1. So, one of the things that are critical, for example, to us is talent acquisition. How can we ensure that the minute we close a funding round, that our companies can then scale from maybe 3 employees to 20 employees in a short period of time, and really get sort of leaders in there that are going to, sort of run the company from, 20 to 200 employees. So for example, one of the things that we built is a proprietary talent acquisition platform where a founder can give us a job description. We can use a bit of ML AI and pull out keywords from that job description, and then essentially pattern match that to like profiles on LinkedIn. And then we can scrape LinkedIn for additional profiles. And then we built out email automation. So basically a founder now can hand us a JD, and in 48 hours, we can send them a top of funnel of 14 candidates that match our criteria exactly. They're excited to talk to them, and then it's on them to close. So we work really hard on sort of creating a platform that's productized for early stage companies and getting these companies from 0 to 1. And I think that's a big part of sort of our secret sauce. So generally for Struck Capital, seed lead investor, really want to sort of be that first institutional investor for our portfolio companies. And when the founders hit escape velocity, for me, it's just the most fulfilling experience ever, because what I find is when these companies raise downstream rounds, it's very transactional. For us, there's as much sort of, it's obviously transactional, but there's also, sort of art and science and a bit of emotions involved too, when you're interacting with a founder in a company at their essentially earliest and most vulnerable moment. But, our bread and butter is sort of leading those seed rounds, then getting with them to a point that they hit escape velocity and become category leaders or category creators. Struck Crypto is a very similar thesis. Again, it's about crypto native technologists and investing in them prior to their token generation event. And then also, really having a high conviction bet, living and dying by those deals, deploying a very robust platform. We have a whole separate platform team for Struck Crypto. And again, we want to sort of get in and lead that first institutional round of financing. And then lastly, Struck Studio, which is actually something that we publicly launched, I think it was around 2 weeks ago, was basically where we said, listen, we have so many information asymmetries as a Web 2 and Web 3 fund, cataloging thousands of deals a year. We can understand where the puck is going, where there's opportunities for innovation. And we actually think, especially like in this market where it's very difficult to raise a seed round, we think there's a ton of founders out there that would be incredible founders, but maybe they have 6-figure salaries that, a 6-figure salary, and it's hard for them to go to their partner and say, listen, I'm going to leave that job and gonna, throw things against the wall and see what sticks, for the next 2 years. Whereas what we can do is we can sort of take our information asymmetries, actually conceptualize these business concepts, put them through internal and external validation, go through product development, identify a buyer persona, find product market fit. And then we think we can go to those types of founders and say, hey, if you join us right now, we've got an investor lined up, we'll spin it out, you'll own 50% of the company, in a very short period of time. So de-risking, getting founders into sort of the startup game, so to speak. And then, of course, that becomes proprietary deal flow for Struck Capital and Struck Crypto. So when I evaluate the totality of Struck and where we are today, is we really want to be seen as early stage specialists. We can identify founders and invest alongside them and have a very robust platform to help them, sort of hit escape velocity. But we also have the ability to actually create companies ourselves and then recruit the founders and spin those out. So it's really exciting to be able to sort of play on both sides of the table. And yeah, Struck Studio is something we literally announced 2 weeks ago, and we did a $15 million round for that. So it's structured as a company selling Series A preferred shares, and got some incredible investors around the table, like Revolution. That's Steve Case, founder of AOL's venture fund, Liquid 2, Joe Montana's venture fund, US Venture Partners, one of the oldest and most historic VCs on Sand Hill Road, and some incredible operators as well.
Incredible. And what a list of names as well. So this one's a little bit for me as I took some time off and came back into the world, and it's definitely changed. So what's your typical investment size? I know you mentioned that you work in that seed stage area, but when I started this job about almost 5 years ago, the seed stage was 3 to 500K, and I've walked into a lot of seed stage funding that's anywhere between 5K or 500K to 5 million. So where does the typical investment size lie for you guys? And how have you seen that change from the time you've started till now?
Yeah, so our typical check size is between 1.5 and maybe 2.5 million. 1.5 to 2 really being the sweet spot. Our goal is, if a company's raising like a $3 million seed round, is for us to take half the round price to take a board seat, and then help the founder build a really robust syndicate of value-add investors. It is, I think the points that you make are very interesting, and when you evaluate the empirical data, it's almost shocking in a sense. I mean, I remember when we really started investing institutionally in LA around 8 years ago, founders were really happy with an 8 on 24. So, $8 million Series A, 24 million pre, 32 post. But what was interesting is the KPIs that you needed to get a Series A were around $2.4 million in ARR, high margin ARR, with around a 15% compound annual growth rate. Now, in 21, when things were crazy, we were seeing $8 million seed rounds and 300K in ARR got you a Series A, and now it's pulled back a little bit, and you need around like $1 million in ARR and a nice growth rate to get a Series A. But what I try to explain to people is, it's still, even with this quote unquote pullback, a lot frothier than it was, 5-7 years ago. So you're 100% right. Round sizes have gotten larger. But I think at the end of the day, what we advise founders is really understand what your Series A KPIs are that you want to hit, and then really work backwards from there. You shouldn't just be raising capital to raise capital. You should raise the perfect amount, because again, whatever capital you're raising that increases your preference stack, that's a bar that you need to surpass in the next round. So, but yeah, round sizes have definitely changed, but it is nice to get this pullback's at least bringing things a little bit more into sort of equilibrium from our perspective. We have a $75 million seed fund that we're investing out of right now for Struck Capital. And last year, I kind of felt like that's a pre-seed fund because the rounds were so large. Now we can lean in and write a $1.5-2 million check and feel really good about leading a seed round.
Awesome. And you sort of mentioned it and actually helps myself on a segue a little bit, but sort of what is the decision process, for Struck? Is there a diligent process in there, and how long does that process usually take?
Yeah, it's a great question. We're extremely data-driven at Struck, so we literally, every single deal that comes in gets stored in our CRM. We understand who introduced the deal, where it came from. Each time an introductory call is taken, we actually score the deal. So it's really cool to sort of aggregate all this data and use it to sort of optimize our deal flow sources and our deal flow processes. Generally, the way that it works is, a deal will come in. the deal team will make a decision on whether or not they want to take an introductory call. Around 80% of deals that come in are automatically passed on because it's just not a fit, for the firm's thesis. If they then decide to take an introductory call, they decide to score the deal, which means the call went well, they then bring that call up at our team call, our weekly team call. And then we as a team decide, if we want to move forward with diligence, give a sort of more robust like due diligence questionnaire, which has, really sort of in-depth, sort of questions relating to total addressable market, competitive landscape, founder profiles, tech stack. It's really, really in-depth. Sometimes there'll be opportunities, especially if a deal is moving quickly, to loop in a full team and also sell the founders. We want founders to understand that at the seed stage, they should really be optimizing for partner more than anything. So we believe it's really critical for the full team to get on the line with the founder, including our head of platform, so they can understand the services that we can provide to them post-investment. And then, essentially, once the deal team has done the full diligence process, background checks, references, all that kind of stuff, we then do a sort of full investment committee meeting, which we call getting a hunting license, where essentially the deal team lead on that, the principal on that deal will essentially present it to our operating partners, our venture partners, myself, and then we blind vote in terms of whether or not we want to do the deal. So it's definitely an intricate process. If a deal is moving really fast, we can do it in like a week. We prefer to have around 2 to 3 weeks.
Awesome. What are some pet peeves that usually that you have as an entrepreneur, pitches to you? Is there, certain things that you just go, I wish I could stop hearing that, after pitch?
Yeah, I mean, entrepreneurs that have, bragged about like starting 5 businesses at the same time, because you're sitting there and you're saying that each business should be like a marriage. We want you to be as committed to the success of this as we are. I think sometimes when founders come in with cap tables that are not clean and there's a bunch of debt equity on the cap table, they've given 25%, the company to an advisor that they like, that just makes it very difficult for us to do a deal. I think definitely last year, founders were not optimizing for partner. They were sometimes not even allowing funds to do diligence. And they were just, optimizing for the highest post-money valuation. To me, I understand why that's desirable to minimize dilution, but I also think that can be very risky if you set the bar too high and then you're not able to surpass it in the next round, and it messes with your strike price and your employee options, your 409A valuation, and you can just be in a really bad place very quickly. So yeah, I think founders that are maybe just trying to be too transactional, optimizing for the wrong terms, and aren't really trying to connect with a partner. Like, in my opinion, when you're a Series D company and you're a category leader and you're raising a large round from Andreessen, I can understand wanting to be very transactional. But the seed stage, it's, there's a lot of ups and downs. It's you can feel great one day and get punched in the mouth the next day. You really want to have a trusted advisor, and the VC that's your board member, who can sort of coach you is really what you should be looking for. So we want founders who are really trying to optimize for partner at the early stage, because they understand how important that relationship is.
No, absolutely. And it definitely, emanates from yourself, very well as well. There's a lot of, personality when it comes down to, coming in, in that seed stage. So what do, successful founders do, flipping the table a little bit on that, besides the complete polar opposite of what you just said?
Yeah. So to me, successful founders are ones that, as I kind of mentioned, want to be coached. They understand that the VC has a very unique horizontal lens. I always tell my founders, we're never going to know more about your business than you do, because you're doing it every single day. But at the end of the day, we have this really unique horizontal lens where we can be working with, 8, 10 or whatever, live seed stage portfolios at the same time. Plus we've worked with thousands earlier, over our history. And we can sort of see patterns and see things before they kind of happen. And if founders leverage that horizontal lens, they can put themselves in a position that they're proactive instead of reactive. And in my opinion, especially for first-time founders, if you can sort of rely on your VC and sort of benefit from that quote-unquote knowledge graph and be proactive instead of reactive, it could make the difference between surviving, thriving, and dying, right? So to us, the best founders are the ones that want to be coached. They're vulnerable. They're not trying to create this like rose-tinted sort of lens scenario. They understand that by telling the VCs what are going wrong, it's actually the best way that they can improve their business. And as a byproduct of being a seed stage company, it doesn't matter if you're the next Airbnb, whatever billion-dollar decacorn. The simple fact of the matter is your business is evolving so immensely at the early stages. When you go from 5 employees to 10 employees to 50 employees to 500 employees, it's a completely different business. And the people that got you from 0 to 1 to 50 employees may not necessarily be the right people to get you from 50 to 500 employees. So as a CEO, you're constantly sort of dealing with an ever-changing, ever-evolving sort of business. It's almost like a living, breathing organism, right? So naturally, there are going to be days where you feel good and there are going to be days where you feel sick, right? And we want that sort of objective candor from our founders. And the best ones, in my opinion, are the ones that are not insecure. They're open and vulnerable because they understand that's how they can actually extract the most value from their VCs.
Absolutely. And to jump upon that point, you mentioned the 5 to 100 and that kind of growing as a business. How do you help companies kind of grow and lead them to raise that next round, as they've gotten to, that level of growth already within that seed stage?
Yeah, so I'm really proud to say, when we look at Struck Capital Fund 2, which is a lead-only fund, we've done 14 deals to date, and we've been marked up by Lightspeed, Bessemer Venture Partners, Craft Ventures, Tiger Global, Javelin Venture Partners, Hyde Park Venture Partners. These are all incredible elite funds. And we obviously, give the credit to the founders. They're the ones that are building the business and hitting their KPIs. But at the end of the day, as a VC fund, there's a lot of different tricks to the trade and just things that we can do to position them for success during that fundraising sort of milestone. So, one of the things that we do is obviously we help them a lot with their financial model and their investor presentation. First-time founders sometimes don't understand that your financial model is literally the bloodline of your whole business. You have to be able to, every assumption in there, everything needs to make sense. And that financial model needs to sort of not only, sort of correlate to your KPIs and your OKRs, but when you're sitting there and presenting the business and trying to make the case that, there's opportunities for massive growth, you really need to understand the nuances. So just putting founders in a position that their financial models are rock solid to the point that they literally understand every single assumption that goes into it. We found that really helps a lot in terms of preparing them. One of the things that we do as well is, maybe 6 months or so before they want to officially commence their fundraise, we'll all of a sudden start bringing them up to the downstream investors that we speak to as hey, this company's doing really well. They're going to be coming on the market soon for a Series A, because what we understand is there's a host of Series A funds out there that don't want to lock horns with Sequoia and Andreessen, right? And they're actually comfortable coming in and potentially preempting rounds. And what I mean by that is you essentially could set up a casual coffee chat with a Series A fund for your founder. And if it goes well, all of a sudden the partner at the fund says, hey, just send me your last board presentation, send me your financial model, and the next thing you know, there's a term sheet. They oftentimes there's Series A funds that want to preempt these rounds, and they want to find these companies 6 months or so before they're actually officially fundraising, because they don't want to lock horns with maybe other Series A or growth stage funds that they believe could outflank them if it was a sort of one-for-one competitive situation. So we understand that. So we do a really good job of sort of setting up casual coffee chats for our founders 6 months or so prior to fundraising. Really, I point them to the right partner at the right firm, especially partners that have information asymmetries in the space and maybe a history of funding companies in that specific vertical. And then generally we can sort of just put them in a place that ideally they could get that Series A term sheet without going through a very long, fundraising process, because it's a distraction to the business. So we play a very serious role in sort of that Series A specifically. Oftentimes we are introducing our founders to the fund and the partner that ends up leading that Series A and joining the board. So when that happens, it's always a really nice situation.
Awesome. And do you, just quick yes or no answer on this one, do you keep in touch with a lot of your previous funded companies and just kind of keep tabs as you watch them grow from each round?
100%. And what I'll just say quickly, so the answer is yes, but what I'll say quickly on that is we have found that it's this very virtuous cycle when a founder is a seed stage founder and then all of a sudden they hit escape velocity and become a massive company. Our sort of interaction with them changes. Initially, it's, hey, we're deploying our platform to help you. The next thing we know, we're reaching out to them and saying, hey, we'd love you to mentor one of our, one of our new founders, or hey, you just hired your organization has 500 people, you just hired a chief people officer. We've got a company that is selling it to chief people officers. Can you connect us to that individual? Because that individual is a buyer persona for our portfolio company. So we are highly, highly incentivized to stay in touch and keep track of our companies during the totality of their life cycle, not only because we have pro rata rights and invest in those subsequent rounds, but also because those founders can then become mentors, experts, and advisors for our new portfolio companies.
Got it. And then just, I wanted to bring this one up because I just thought it was, fun and really kind of, identify Struck, but also yourself a little bit. Being based in LA, it's the worldwide hub for entertainment, film, areas of that matter. How has that benefited Struck, growing in the technology and startup space, but also kind of become a little bit of a name in that area as well?
Yeah, we feel really privileged to sort of have the support, of large players in Hollywood. Leonardo DiCaprio is one of our investors, and it's been pretty incredible to leverage his platform where appropriate, and just to sort of see his sort of impact thesis and how that's actually manifested in him doubling down and investing in some of our portfolio companies that are in that space. We've other, members, investors in the fund, that include like Brian Robbins, who's like the president of Nickelodeon, and Tom Ryan, who was the CEO, is the CEO and co-founder of Pluto TV, which he sold to Paramount Global, and he's now essentially the CEO of all of streaming for Paramount, and the head of Paramount Plus, is one of my partners now at Struck Studio. So just generally, we feel like we've gotten a lot of support, from sort of Hollywood entertainment, et cetera. And we think there's a massive sort of convergence, right, between, Hollywood, media, LA, and tech, VC, all in this wonderful ecosystem that we call Silicon Beach. So yeah, listen, I think when I first got to LA, it was kind of like, oh, you can only build like media companies here, like social networks here. And I think people realize now that you can build any company you want. And there's actually a really, really robust, and deep bench of engineers, many of who are trained in the sort of like UC, system. So from our perspective, you could build any company you want here, SaaS, it doesn't have to be media focused. And, I think we've really sort of are trying to play the role as sort of like that next generation of venture capital in Los Angeles and really align ourselves with the ecosystem. I think obviously in a post-COVID world, things are so distributed and people are all over. And between Struck Capital, Struck Crypto, and Struck Studio, we're 21 people now. We actually have our new website is coming out shortly, and the team is distributed, between places like, New York, LA, Austin. But at the end of the day, we think LA is really, really important to our thesis, to our identity as a firm. And we really want to make sure we're doing our part to support the LA ecosystem as much as possible.
Incredible. So before I jump into some of the questions from the audience here, I wanted to just get one last sort of major question out to you. You mentioned it just briefly there. So you did spend the last few minutes for the recent changes of Struck, between Struck Studio, Struck Crypto, and sort of what you guys sort of are planning going forward. But what do you see coming in Struck's future? What are some maybe outlandish ideas you may have that you guys are kind of aiming for, maybe a couple of goals that you guys are looking for, 2-3 years down the line as well?
Yeah, we've invested a lot, not only in having Struck Capital, but then also creating a full separate investment and platform team for Struck Crypto, and then now launching Struck Studio. I promised my wife that I'm not launching any new business lines going forward, so that's about it. But I think it's really important for us that sort of these investments really pay off. Struck Crypto, we launched in 2017, and I'm proud to say that, if you invested in that fund at inception, you put $1 into us, it's worth $10.80 net of fees. The same dollar in Bitcoin is worth $1.80. So we've really outperformed. But I'm trying to establish Struck Crypto as one of the top Web3 funds in the world. So we definitely have goals of getting to that point. On the Struck Studio side, if we can actually be in a position where we can productize the concept of spinning out companies, and then it becomes proprietary deal flow for Struck Capital and Struck Crypto, I think we turn ourselves into potentially one of the best early stage investors in the world, because we literally can create companies and invest companies and just generally deploy a very cohesive platform that can grow companies. And that's sort of a main goal for me. So we really put ourselves out there as a firm, and me particularly, obviously as the CEO of Struck Studio, because I really want to make sure that we're successful. We've got 3 concepts right now in product development that are extremely exciting. So hopefully we'll have that first spin out sooner rather than later. And then for Struck Capital, which is sort of where it all started, and sort of the core of the Struck platform. We're going to be going out for Fund 3 in the beginning of Q1. So obviously, we pay a lot of attention to the macro environment and want to see how things turn out. But from our perspective, we've got really stellar results. So it'll be excited to maybe do like $100 million Fund 3 and maybe a bit of an opportunity fund, because we just have a lot of companies that are very downstream, have been significantly de-risked. And we know there's a lot of investors that would love to get on those cap tables. So yeah, I think when I evaluate sort of Struck and where we are, it's really a major turning point for us. You really know who you are by the time you get to Fund 3, and if you're able to pull that off with institutional investors, I think you can then really hang your hat and say, I'm a real VC. So we want to get there, and then yeah, a lot of high hopes with Struck Crypto and Struck Studio, and just generally it's very exciting for us. We want to continue supporting the ecosystem. We fundamentally believe that we can create companies that are also mission driven, and actually make the world a better place and give back. And that's a big focus for us as well. So yeah, just want to keep building.
No, absolutely. And you definitely, you mentioned the inception of the business. I don't know if that was a Leo pun or not, but it works for you. Congrats there. I'm going back into the chat box here to figure out a couple of the questions, but I think John Taylor, he's asking, what advice do you have for a pre-seed startup raising money? Is there a sweet spot, and how much is too much to ask for, or how much is or what's too small for a pre-seed? So what's kind of that range that somebody should be aiming for these days?
Yeah, it's a really good question. You have to get to a point, right? Again, you don't just want to like raise a round to nowhere. So if you're going to raise a pre-seed round, you really want to make sure that you understand what you need to demonstrate to then raise the subsequent round of financing, which essentially will be your seed round, right? So whatever your definition is of traction, it's obviously going to change if it's B2B or B2C or B2B2C. Understand what your KPIs are and work back from there. We're typically seeing pre-seed rounds in around like the $500K to $1.5 million range. I think anything more than $1.5 million is probably a seed round, and then you should probably maybe just try to go for 3 million because you don't want to raise too little. But yeah, I mean, I think obviously every founder's valuations, dilution sensitive, and the concept of selling off too much of the company at the pre-seed round, something that one needs to be cognizant of. But I also feel like if you raise a small amount at a very high valuation, again, you're just putting a lot of pressure on yourself and the company in the early days to make sure that you can surpass those KPIs and then raise a subsequent round of financing with material valuation appreciation, which is something that you and your investors and employees will expect to see. So, if it's me, I really sort of, and if it's me and you can't go into a seed round, you just fundamentally are not in a place where you can, identify a buyer persona, get someone's product market fit, put a good team around you, another co-founder, and get a VC to give you a full seed round. If you have to go the pre-seed route, that's totally fine. My advice would be, raise $1 million, $1.5 million, depending what your KPIs are, and just make sure that you're really optimizing for partner. The early partners that you bring onto the business, your co-founders, your investors, your board members, they will make or break the company. So just very critical to be level-headed and rational when making those decisions.
Yes, and feel free to confirm this one. So you guys are industry agnostic, right?
Yeah, so we're technically industry agnostic, and a generalist fund from a mandate perspective. We don't do biotech and we don't do hardware because we just find those things are very specialized. And generally, we gravitate towards areas where we believe we have information asymmetries. We talk a lot about self-diligence. Why should we be the fund that's leading this seed round for this company? We've had a lot of success on the Web 2 side and horizontal vertical SaaS. We've done a lot in MarTech. We love sort of like API economy, soft infrastructure plays. And then obviously in Web3, it's very focused on the blockchain ecosystem, and specifically core technology innovation that's solving major problems like the blockchain trilemma. But yeah, so I would say, yes, we're industry agnostic, but we definitely have a few sectors that we don't invest in particular biotech and hardware.
Great. and longtime friend of Early Growth, Dylan Peters. It's good to see your name come up. He's curious, what do you think plays the biggest role in startups that make it versus those that don't? I know we've gone through a couple of the pitfalls and a couple of the success stories, but what do you think is the major differentiator between those?
Gosh, I mean, there's so many, it all depends, right? Like sometimes a business can really be impacted by macro tailwinds or headwinds. You thought you had a macro tailwind and then things just changed on you. Maybe there was a regulatory moat that you thought you had that you didn't, or some arbitrage situation that now closed up. And then all of a sudden, it's harder to raise money. The VCs aren't attracted to the space anymore. So I definitely think sort of wanting to have the wind at your back and having sort of macro tailwinds is very helpful. But if I had to pick like one specific thing of what do I think makes a startup successful or not so successful, I think it's the ability for the founding team to really delegate. At the end of the day, as a founder, you cannot do everything. You have to have the gravitas to recruit the best people in the world to come and join you on your mission, and you need to give them enough responsibility and delegate to them so that they can sort of shine and sort of fly and sort of hit their potential as well. So I've noticed extremely talented founders that it's difficult for them to delegate. They also don't understand that, if you're at recess and you're picking your basketball team and you have the opportunity to pick Michael Jordan, you should, because that's how it works, right? When you hit a Series A and you raise $10 million, all of a sudden you can hire True Search and Diversa and start bringing in rock stars, 10Xers that have done this before at leading companies and scaled venture-backed businesses. You have to do those things, especially if you're a first-time founder. So I think founders that they can't delegate. They don't want to recruit incredible talent because they feel threatened. There's a lot of weird dynamics like that that, in my opinion, will really kill a business.
Awesome. And then Jack Shaw was wondering, what percentage of ownership does Struck take when bringing in the investment? Is it based on the size of the investment? How does that structure sort of become?
Yeah. So like our prototypical round for us would be, say like a $3 million round, let's just make it easy, like $15 million post, we cut a $1.5 million check for 10%. So we're typically trying to get, double digit ownership. 12.5% would be nice. 8% would kind of be our threshold. What we've found just generally is we're putting in the same amount of work for a company that we own, 8% of or versus 12.5%, right? So we really want to write that high conviction check. Get behind our companies, and that mandates, ideally a double-digit ownership threshold.
Great. And then I think it's sort of piggyback on that, sort of ones that I've seen in the past. How, through its sort of life cycle, how much of the company should people sort of, be willingly, be able to kind of give away for those rounds of investment? Do you have an answer for that, or is it?
Yeah. A typical round, if it's like seed Series A, should be between 20 and 25% of the company. Once you have more robust KPIs and you're in more like growth stage territory, companies can get away with maybe around 10% dilution in a financing round. But at the seed stage, Series A, very typical is between 20 and 25%. Anything over 25%, in my opinion, is too dilutive, and it almost looks like there's a problem with the company. And gosh, if you can get less than 20% dilution, by all means, you should go for it. But typically, just in terms of the ownership requirements that VC funds want to have, that's typically where it is. And what I'll just say generally at the seed stage, people aren't doing like a discounted cash flow analysis to arrive at a valuation. A lot of the times it's really just saying, let's look at the totality of the cap table optics, how cash efficient, how, this sort of businesses, what do they really need to get to that next round? And how can we put them in a place where the VCs own enough, but the founders own enough? We don't want to, as a VC, you don't want to over negotiate, because the founders need to own enough of the company to feel, incentivized to keep running it 10 years down the line across multiple subsequent rounds of financing that have dilutive impact. And if you start negotiating for off-market terms, then you get, participating preferred and 2x liquidation preferences and all this type of stuff. Well, when you go out for the next round, the VCs are very aware of those rights and privileges in a certificate of incorporation, and then they're going to ask for it as well, and they may be above you. So for us, it's really about, making it simple, optimizing for partner, keeping the cap table clean, getting our ownership percentage, but also making sure that the founders are incentivized to run the business for years to come.
Awesome. So I think we have time for about 2 to 3 more questions. So if you guys do have anything more, feel free to put it in the Q&A chat. But for right now, how often do you speak to your portfolio companies? Sort of what does that relationship look like on a day-to-day side?
Yeah, so we're really hands-on. We have a weekly, if a portfolio company of ours is at the seed stage and we are on the board, which is every time now, we 100% get them into a weekly cadence where they're meeting with our platform team. We structure every single meeting, so we're always talking about the same things, KPIs, talent acquisition, business development, all those types of things. Then on top of that, obviously we have quarterly board meetings, but we do a lot in terms of onboarding our portfolio companies to actually show them how we want them to communicate with us, how we want them to communicate with other investors, how we want them to communicate with sort of downstream funds, because again, a lot of that stuff can be productized. So we want to be really hands-on with our early stage companies. We really want to sort of help them go from crawling to walking to running to flying. And we have just found over the years that it's really, really critical to put in the time. I think there are a lot of seed stage funds out there that'll write you a check, and just check in quarterly. And I just don't understand how they can justify, adding value with that type of a communication cadence.
Awesome. So Carlos is asking, how do you shop your portfolio companies to find the best possible liquidity event for your LPs domestically and globally? And do you do globally as well?
Yeah, it's a great question. Generally for us, these are 10-year funds, and we really sort of, we're long-term, sort of capital providers to our founders, and in that sense, we don't want to like put pressure on them to get a liquidity event, sooner than necessary. Our ideal situation is for them to hit, 100 million ARR, high profile, high margin recurring revenue, and have the KPIs go public, right? And that's the ultimate goal. But naturally, there's obviously going to be M&A opportunities, and usually these companies are aware of sort of who are the other companies that have enough balance sheet to theoretically, purchase them. And if they get to a point that they want to run a fundraising process, or an acquisition process, we know a plethora of investment banks, et cetera, and can help them through that. The nice thing though for us is we're early stage investors, we're seed stage investors, and when the companies go and raise Series Ds and Cs and all that, they have funds that also join their board, right, and that are also very focused on sort of that acquisition scenario, because they understand that they're entering these companies much later in their life cycle. So we always have partners in that sense as well. In terms of an international, I mean, we just for an example, I mean, we've sold companies to Robinhood. We've sold companies to New Relic. We've sold companies to Klarna. We've had a lot of sort of unique acquisition scenarios. I think what I would say for us is if it's a downstream acquisition, meaning the companies really hit escape velocity, it's usually very easy for them to be identified. They're category leaders. They're in G2 or Gartner. Everybody knows who they are. They're high profile. The times where we actually play a very important role in terms of helping our portfolio companies find liquidity events are actually when maybe the wheels are falling off the bus, right? And they raise a Series A, but they can't raise a Series B, but they've got a strong engineering team. They've got a bit of product market fit, some traction. It's really important for us in those types of scenarios to make sure that we're protecting investor principal, and we can arrange what are called acqui-hire scenarios, where we'll find other companies, typically companies we're very friendly with, sometimes even in our portfolio, that will come in and sort of purchase the company and give the investors their money back because they want the engineering talent that's on the team, or they're really impressed with the CEO because they have robust information asymmetries in the sector. So those are the types of things when things are not going well, where the early stage VC plays a real role in making sure that we can try and protect investor principal. For downstream, it kind of sorts itself out, right? Because these are category leading companies, and they're almost in a situation that acquirers come to that.
Awesome. And going back a little bit to being industry agnostic, when a company comes to you, what sort of shouts that you want to invest to them? Is it sort of what the company's vision and what they're doing, whether that be an eco-tech company or a studio or media-based company, or is it more the person or the personality behind it?
Yeah, I always say you can have an incredible idea and a so-so founder, and it's probably going to fail. You can have an okay idea but an incredible founder, and you're probably going to be successful. So we really optimize for founder. The granularities that we go through during the the diligence process are very robust and continuously get more complicated But at the end of the day, it's actually a very simple business. You're identifying incredible founders that the ability to leverage their information asymmetries, build massive companies, they can go through adversity. And a lot of the times, I don't care how much diligence you do and how many macro tailwinds there are, if you get the founder wrong, it's gonna be really hard to recover from that. So in a sense, we are very founder centric. But we go a lot deeper than that as well, right? It's really important for us, especially like in this market, that the business has sustainable unit economics, high margin revenue profile, a competitive landscape that's not too saturated. And we really want to have a sort of sustainable business from from an economic profile. So a lot of those things are necessary as well. But if I had to pick one thing, you should always optimize for the best founder.
Awesome. I think through the chat box as well as the Q&A, you have made a lot of fans here. So before we sign off, and again, I can't thank you enough for your time today. What's the best way that founders can reach you and follow you as well? So a lot are asking for some way to be able to be in contact and be able to talk a little bit further about their businesses as well.
Yeah, so feel free to email. It's very easy. It's just adam@struckcapital.com. We're highly responsive and can get you in front of our deal team very quickly so that you can commence the process. And then we have we're on Twitter and Medium as well. To be honest, that's a big thing for us, is just to invest a little bit more into that aspect of the business. But yeah, generally, if someone wants to get a hold of me, definitely feel free to send an email.
Awesome. Well, again, thank you so much, for your time today, and really appreciate you, being part of this. Hope to see you again here.
Yeah, it's been a real pleasure, and looking forward to doing it again in the future.
Awesome. Well, thank you guys, everybody else, for attending. Again, if you want, Adam, if you want to, feel free to throw your email into the chat box. I'm sure everybody would appreciate that, and be able to kind of go from that point. So we'll hope to see everybody else here again for the next Meet the VC event. And thank you again for everybody for attending. Appreciate it. Bye.
Thank you so much, guys. It was been such an interactive session. Okay. All right. So for our future Meet the VCs, we have upcoming Meet the VC in September 14 with Tammy Obayomi from Sapphire Ventures. Hope to see you all again soon to have such an interactive session again. And all of our recordings, this one and all of our previous webinars recording are up there on the YouTube. This one will be uploaded in 48 hours, as mentioned, and will be shared through an email as well. Thank you so much, everyone. Thank you, Adam, for your time. Thanks, Greg.
Thank you.